Welcome back. And in our top business story, Dubai Investments is looking for funding for the second phase of the Musafa manufacturing unit of Emirates float glass of up to 734 million dirhams. An upgrade of the EFG factory was officially inaugurated yesterday, and Khalid bin Kalban, the managing director and chief executive officer of Dubai Investments, said his company is also exploring a sukuk to fund the expansion. The unit covers 320,000 square metres at a cost of 700 million dirhams. Phase 1, which has been operational from 2009, can produce up to 600 tonnes of glass per day. That's 190,000 tonnes per year. The second phase is set to produce another 600 tonnes a day and will be the largest in the UAE. The negotiations are currently underway with a number of regional investors, banks and institutions. Abu Dhabi International Airport saw double-digit growth in passenger traffic in February, with a 24.5% rise in passengers. Additionally, aircraft movements increased by 3.8% to 9,263. The report released by the airport accounted this growth to a number of new destinations with its flagship carrier Etihad, including 5 flights a week to Shanghai in China, and the operation of new airlines, including Safi Airways of Afghanistan, which now operates 4 flights a week to Kabul. MR Properties has proposed a 10% cash dividend for 2011, having paid a 10% cash dividend worth 600 million dirhams to shareholders for the previous year. The firm is 30% owned by the Dubai government, and according to a statement on the Dubai Financial Market website, shareholders are set to meet on April the 23rd to look at the proposal. Additionally, the developer stated that it will expand its board members from 8 to 11. And with that, let's now take a look at the stock indices across the GCC. Policymakers announced they are targeting an economic growth rate of 7.5% for China this year, slower than in past years. So how accurate are these growth factors, and how can the yuan gain the credibility it needs to become an international reserve currency? Well, we earlier spoke with Tim Fox, the head of research and chief economist at Emirates NBD.
I think the revised Chinese forecast for GDP to grow by 7.5% this year reflect a recognition of the reality that conditions both externally and internally are deteriorating in China, the second largest economy in the world. At Emirates NBD, we have a forecast of 8% growth, down from 9% last year. China is attempting to switch from being an export-oriented economy to becoming more of a consumer-driven economy. This process is complicated and is exposing previous misallocations of resources, particularly in the real estate sector. Recent economic data has highlighted some of these downside risks to growth, with a large trade deficit recorded for January as exports declined, while at the same time the domestic economy does not appear to be able to take up the slack, with house prices souring and retail sales weakening. I think in order to prevent the economy from slowing down faster, more stimulus measures may well be needed by the Chinese authorities. I think the slowdown we are currently seeing introduces new uncertainties into the Chinese yuan exchange rate as well. As you noted, China has aspirations to make the CNY, or the Chinese currency, an international reserve currency, but that will take quite a long time to happen. The CNY is currently a managed currency, and there are also restrictions on capital flows in China. So it's not going to be a case of achieving international reserve currency status overnight. It is going to take time, and I think the reforms underway in terms of adjusting their economy are all important ingredients in moving China along to raising its status and also increasing the profile of the Chinese currency.